Good Thursday morning, chameleons. Thanks for joining the show. Here's the main man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
You want to start with a disclaimer?
Yeah. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All righty.
And with that, let's get started. I'm going to share my screen. If anybody out there is joining us for the first time, we do this show every morning to try to help answer questions you may have about the Market Chameleon tools, data, analytics. You could come on a show. We put out a link to Zoom on that YouTube. If you click on it, it takes you over to Zoom. Once you get into Zoom, there's a button at the bottom of the screen. Raise your hand, click on that. You don't have to turn on your video camera. Once we let you in, you could ask your question. Everybody could hear you. You could ask it directly and live, navigate us to where you're looking. If you prefer to type in your question, type it in on the live chat on YouTube, and Will's watching it. He'll read them back to me. So what we're going to do is, while we're waiting for questions to come in, we're going to give a little bit of time for people to either put in their questions or come in and join the live show. We'll start out looking at what's trading in pre-market hours, see if we can get some insights. If we get questions, Will stop me, let me know. If not, I'll navigate to other parts of the website, see if we could get some other insights there while we're waiting for people to come in and put in any questions you may have. Okay. So pre-market report. These are stocks trading in pre-market hours. And we have three lists here. List of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, and I see 34 stocks made our percentage gainers list, 47 on the decliners. So from this perspective, we're looking like a slightly bearish bias at the open. If you look at this list, there are stocks in there, that are small cap stocks, ETFs, leverage products, preferreds, closed-end funds, whatever trades on the major U.S. exchanges. If it's trading in pre-market hours, meets our thresholds, it could make this list. So what we want to do is narrow down the list to a smaller group of stocks. And what we'll do is take a look at S&P 500 companies. To do that, I'm going to use the filters here above. And these filters control the data tables below. This one in ETF, if you click on it, it's a drop down. You get a list of ETFs to choose from. There's some sector ETFs in there, some broad-based ETFs. So the top ones, SPY, Dow Jones, NASDAQ, broad-based ETFs. And what we'll do is pick SPY, which is the S&P 500 ETF. Let's click on that. When you do that, the tables below get filtered by stocks that are holdings in SPY or in that ETF. And here we see three stocks made our percentage gainers list, 4 in the decliners, and pretty neutral from that perspective. At the open, I see, maybe the only one up here, just that the ones on the decliners seem to be declining by a bigger magnitude. So if there's news out there that we pick up on, you'll see this little end alert. So if you hover over it, you get some headline news there. Sometimes that kind of tells you what might be going on in that stock. Let me see, we have like 6 minutes into it. Any questions yet?
Yeah, we have a new user popped in, Felix, and I'm waiting for maybe a response for what exactly he's talking about. But okay. He's asking, hello, Demon Will, what is the source of all the market alerts you are updating on your website? I would love to learn how you find these options trading ideas by myself.
Yeah, we're the source. The source for the alerts is we don't, those those alerts are generated by us. Our data, the data is driven through our, algorithms, models, and then we generate those alerts. So the alerts that you're seeing, those are being generated from using, our either our models or benchmarks. They're hitting certain thresholds, and we generate those alerts. So there's we do buy and license raw data from exchanges. We do take unstructured data and information. We do structure that in-house, and we also subscribe to feeds. There's certain raw data we do either license, purchase, or subscribe to, but then we use that data, right, as inputs into our own models or our own benchmarks to try to explain the human behavior or market's expectations, or create benchmarks from that raw data to generate these either ideas or something unusual, whatever those alerts may be. But yeah, those are being generated by us. I think you're on mute, Will, if you're following up on.
Yeah, I was having a coughing fit. No, that's perfect. I don't know if you want to show. I mean, again, though.
Yeah, I'm not sure if you're looking at the either the alerts being generated here, that's our alerts, or if you're going to like maybe the original articles or trade ideas. So these these are all generated by us, kind of trying to give you these you could start looking. Right now we're publishing them out for free, so to give you an idea of some of the trade ideas that you would be able to find under here, right? So these would be like trade ideas that you could go under like Tesla and look. If you're looking for bull call spread, bear call spread if we find one, and so forth.
Perfect.
Yeah, and we do lots of videos, how to.
All right, so here he's following up. Can I make my own trading ideas just from theoretical value? And Rob actually mentioned something earlier, which was a good recommendation. You can build any trade you want, create it, and then go through the different data of that trade.
Yeah, exactly. You could go into the options chain, right, and create a trade, and then run a theoretical value. So, here's put spread, selling a put, let's say for 405, 160 put, and then buying this 150 put. So you could see here, this is some of my internal stuff, but over here, you'll see this. It sets up the trade for you, right? So selling the April 160 put, 405, buying the April 150 put, 237. So you could go through here. You could change some of these assumptions if you want, the prices, the ratios, and calculate it. It'll start you out with the payout diagram at expiration, but then you could go through the models and look through theoretical values. And there are a couple different ones. This is a theoretical value. You can see here the model is using 4 years of data. You can change that. It's using a dynamic IV range, basically what it's going back into history and looking at data where the implied volatilities were similar to today's current levels. And this goes through historical stock behavior to generate a theoretical value, so you could compare it to the market. All right. Of course, you could change the years. If you want to just use 2 years of data, 1 year of data, and that will regenerate, the theoretical values based on the data set that you're using, right? So this way you could compare it through different data sets. So this is doing it through actual historical stock returns. This one, IBKR, is looking at how did the markets at this point in time, if we pick similar days to expiration, strike similar distance away, and if we use the historical premiums, how were they priced historically on average versus today? So this spread right now is bringing in 168. The average was 171. So you could say, this is a little bit less than the average. Here's the high and low. So we did a lot of videos on this, on the theoretical values. You could find them on, like, I'm sure on our YouTube channel, MarketChameleon. But that's what it is. It's driving the data through the models to create those benchmarks.
Perfect.
Yep. Let me see. We could talk about, if he has an example he wants to walk through, a specific one, I could do that if he wants to.
Yeah, Felix, if you have a trade idea you were looking at, or a stock you were looking at doing a trade in, just let us know and Dee will try to look at it.
Yeah, and I'll try to walk through a specific example. If you have, then I'll go through it.
Actually, we got a question. I missed Mike. Had a question. He was asking, what time does the pre-market start posting quotes?
Right. So when we look at the pre-market trading, let me see if I could. Let me see if I could go to the pre-market. So this is in Tesla. So if you look, you see here in the pre-market, so this is starting with like 6 o'clock right here. So you could see what it's been doing since 6 o'clock. We start updating it when we start first updating it ourselves, right? So you could see that there's choppiness always, like very early in the morning. Might even start at like 4 a.m. Let me see if I could see the. So look, see, at 4 a.m. it starts. So you could see this data if you wanted to go back till 4 a.m. We don't start updating it at 4 a.m. We start updating it ourselves, and we'll show the history of it. That is in line with the news cycle. Okay, so once the news cycle starts coming out, we start updating it, because before that it's just very choppy, very illiquid. And what you'll see is, like, over here around, I think the news cycle starts around 7. That's when around 7:15, something like that. So this is when we'll start updating it, or I believe around that time. So not at 4 a.m. or 5 a.m. We won't update it, because it's just choppy. And again, it is not in line with when the news cycle starts, when the press releases start coming out, when you usually start hearing, like, conference calls and announcements, and when the news cycle starts, that's when we started. Otherwise, you're going to get into very illiquid markets anyway, very choppy liquid markets. So, we kind of put it in line with that news cycle. I don't know if there's a follow-up on that. What you're on mute?
Nope, no follow-up. That was good. Thanks.
Yep. Okay, right. And if you wanted to go back, you can go backwards and look, but that's when we start updating. I believe it's like around here. around seven-ish. Let me, while we're waiting for follow-up questions, or if there is a specific question, and I think you said it was Fields, he's welcome to come on a show and maybe navigate us to what he's looking at, and I'll walk. If he points me in that direction, I'll go through an example. We started talking about yesterday the positioning, right? And trying to analyze the markets from the perspective of anticipating or measuring the demand for stock and supply of stock. Because ultimately, where's for stock prices to get pushed up, there needs to be a source of demand or continuous source of demand and down source of supply. And, we do know that there is like a constant source of demand coming from pension funds, retirement accounts, right? Because people work, they're on auto invest, it just gets taken out of their paychecks, and then it goes into a lot of times just into a passive mutual fund, or sometimes they'll do it into an ETF. So there's a constant source of demand coming from those types of accounts. I think they're about 35% of the market at this point. Okay, so it's 35% of the holders are these retirement accounts. And these are accounts that we would call, mostly passive. These are not like, actively managed or fundamentals. These people are really just buying the stocks because they're incentivized through our tax code to put money into that account and buy stock. Okay, so that there's a whole incentive to do that, and that's why they do it. Probably a lot of it wouldn't have been done, if there was no incentive, because they could have just saved the money or whatever. So there's a constant source, and that source, it'll go up. It'll go up if employment is going up, the economy is doing well, and wages are going up. So you could anticipate those kind of things to increase, right? If unemployment increases, people are losing jobs, they're more worried, their incomes are not going up, that could decrease, right? So that's, there are ways to measure, but I'm trying just to make the point that, one of the things that on Wall Street is studied is the sources of demand and supply of stock. Okay. And most demand right now, I would say, is very passive and non-fundamental. So even when you invest, let's say in SPY, right? Let's say SPY, you invest in this ETF or mutual funds that are index based. These indexes have been growing over the, over 2 decades. They've been growing and really gaining lots of assets and lots of investable dollars. But the index itself has nothing to do with actual fundamentals. Like SPY, let me show you something. SPY ETF, it's a methodology of investing in stocks that has nothing to do with forecasting the economy or forecasting earnings growth. None of that happens. It's all market cap. It's just based on a calculation. It takes the highest market cap stocks, and every time you buy $1 of SPY, they say, okay, well, Apple has the highest market cap, so Apple gets 7 cents out of that dollar. 7 cents out of every dollar will buy Apple stock. Microsoft 5.6, and that's what it does. So you got to keep in mind that this has been going on for decades, and that when we're raising interest rates, we could start seeing a big deviation between fundamentals and valuations. Right now, we could start really deviating, because when you're buying SPY, yes, you're buying diversification, right? But it's not a managed account where somebody sitting there and saying, "Oh, wait a minute, the market is too high. The bonds are paying better. Sell stock and put it in cash." It doesn't do that. It just sticks to this methodology, right? So even if forecasts go down or whatever, take it and just push that money in. Okay. So it's not really fundamental. It's more of just like the more money goes in there, it just builds that pyramid. And what's happening right now is also that some of these stocks are becoming, it's not as diversified over time. This is what, and some people are starting to notice it, is yes, you have 500 stocks in there. So it seems like, oh, I'm well diversified, but it is cap weighted. So the more this goes up, the more money or the bigger share of dollars it receives. Let me show you guys something. Let me see ETF profile. So at this point, here are the top 10 holdings in SPY. They make up almost 26% of the entire S&P 500. And if you look closer, out of these 10, it's probably a little bit worse than that, because Google has 2 classes of shares, so it's in there twice, right? So you could say it's really 9 companies that make up 25%. In addition to that, you got Berkshire Hathaway in here. And Berkshire Hathaway is a holding company of a lot of these stocks. So you could say that a lot of the Berkshire Hathaway value comes from, its holdings of Apple and whatever, Amazon, whatever they're, so basically he's holding a lot of stocks in Berkshire Hathaway as well, which is, like, you could say, a little bit also double counted. So what we're seeing now is like the undiversification of some of these indexes, because a lot of them are just cap weighted. And more money keeps flowing to the top as this happens, right? So as these market caps grow, they get a bigger share of each investable dollar going into these market cap weighted indexes. In addition to that, a big source of demand for stock, and you guys probably hear about it, is stock buybacks. Again, I'm looking at like non-fundamentals. These are just sources of cash flowing into the market to buy shares, right? So demand for stock goes up. You take stock, you buy stock, take it off the open markets, you take out the supply, the stock's going to go up. So a lot of these stocks that we're seeing here, not all of them, but Apple, whatever, they're taking earnings, their cash, and then they're going and buying their own stock, right? So which is, again, it's because it's tax efficient, right? A way to give back shareholders their money is like through dividends. But if you pay them a dividend, the shareholder has to pay taxes on it. So if you take that money instead and just buy back the stock, it's more tax efficient, although that's starting to be taxed. And we got to think about $1 trillion worth of stock buybacks. So think about all that money. That's another big source of demand for stocks. Got about $1 trillion just flown into the market constantly from companies buying back shares. And a lot of that is also unproportionally skewed towards these big companies. I think Apple, Microsoft, Meta is up there. So let's take a look at Apple, for example. So these are Apple fundamentals. And let me go to the income statement and I'll show you. So this is by quarter. And here is, where is it? All right. So here are Apple's outstanding shares. All right. So we could see, basic shares, diluted average shares, that they've been declining. Basically, they've been buying it back. So when you're buying it back, you're decreasing the number of shares outstanding, right? That's it. And they're creating that demand themselves, pushing that stock higher. So now it's starting to kind of accelerate. I'm just showing you how these things can accelerate, where there's lots of pressure. And I feel like now you're becoming less diversified than people think. This could become a problem, actually. So where is it coming from? Let's take a look at the cash flow statement. Look at quarterly here. So these are Apple's cash flows, right? So you could see that they're generating a lot of cash from their regular business operating income, right? So this is like from their daily operating business of, selling iPhones and services. They're generating a lot of cash. Here they invested some money, so that was cash flow out. And here you could see they bought back some debt, so that's cash flow out. And here you could see that they're buying back about $20 billion worth of their own stock. And what this can do, when you're creating so much, demand at the top, is starting to push valuations away from the fundamentals, right? So they could start to really deviate there, because you just got this constant flow of money into the stock, right? You're taking stock out of circulation, and you're constantly just pushing more and more money into it. And it's like on autopilot, and eventually what's starting to, and this is something the Federal Reserve made note of. They said that they're looking at the markets. They study everything, about the economy, and they're starting to see something similar, that I'm trying to, kind of point out, is that even though there's greater uncertainty and to earnings and growth, and the fundamentals, are starting to decline in the face of uncertainty and higher interest rates, the valuations are deviating from that. And that, that's something, and because of this constant flow of money, it could start to really, push things apart. But anyway, we're right up at 9:30. I wanted to.
We did, as you were on the sheets, we had a couple questions come up. We'll get to them tomorrow. Raj was asking a question. Rob was asking a couple questions about buybacks and bond funds. So we'll get to that tomorrow. Great job, Dima. Everyone, remember, thumbs up for Market Chameleon, please. Hit subscribe. That all helps. Awesome job, Dima.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, everyone. Have a great day. Bye-bye, D.